How's that, YouTube? Looked like it solved the problem. I see the equalizer moving now. There's a bit of a delay, so I'll just keep going and they'll let me know. All right. So looking at what's going on around the world. No, thank you. Anytime you got an issue like that, tell me. I did a stream once and was talking for 30 minutes and nobody said that they couldn't hear me. That was a very frustrating day. Like, why didn't somebody say something? They just seen my mouse moving on the screen and me changing tabs and nobody said anything. That was very frustrating. So I appreciate it. Hong Kong is basically flat with Japan. The Dow up a little more than a quarter. Small caps leading the way at of 0.5%. It's not a bad morning, but we really don't have much, right? We haven't really done anything. As I mentioned at the start, we got some jobs data, so we want to focus on that. Anytime you have jobs data, it's worth taking a look at what you're going to get out of it. We have the 30-year bond auction today and the 4-week, so a little bit of the front end of the curve and then the back end of the curve. Logan's going to be chipping his teeth tonight, so if you're trading in the after hours, be mindful of that. But, you can probably dig into this a little bit because we got Marion and Logan. If these are pre-recorded or if, there's at a dinner or a fundraiser, it's likely they're not going to be impactful, right? And if there's no Q&A, no reporters with gotcha questions, then if you're trading tonight, probably don't need to even be concerned with them. So just dig into a little bit if you're going to be trading in the Globex this evening. I heard a lot of people mistrusting the data that we got yesterday and a little bit of lip on trusting the data. Look, it's the government. We all know the government is shady, dirty little scoundrels, and it doesn't matter who's in office. That's just the way it is. It's the way it's always been. So yeah, you have to look sideways at the data that we get. But that isn't new. Okay? It's always that way. That's why we have multiple sources when it comes to the different economic events that are out there. Some are private, some are government, and then we can compare the data between the two. All right. So the call wall and the put wall didn't move. Some of the other levels did, but I don't track them on the day-to-day basis. We're still running inside day. After the second inside day, it's called an IX10. I didn't name that. I kind of wish I had because it sounds neat. But nope, that's not one of mine. That's just a pattern. Now, an old school pattern calls it an NR, right? Narrow range, and then you put a number behind it. NR7, NR10. Narrow range patterns have some great follow through, but it's an old school concept, and we've kind of outpaced that over the years and come up with more sophisticated systems. Still, if you're getting into technical analysis and you're trying to learn about the different styles of analysis, you could dig into the NR system and kind of learn more about it. Just because it's outdated and we use a newer system doesn't mean you won't get anything out of it. I call it an IX10. It's a bit more modern. It uses an OCR style of approach, one candle reversal OCR. It's a very new style of analysis. The idea behind this is that when we've got an inside day and then another inside day, that we're no longer just having an inside day, we're having a collection of them. So we're in this IX10 setup. If we were inside of a really big range, say Thursday and Friday's range from last week, those were massive bars. Being stuck inside of that doesn't offer any additional benefit, right? Like, who cares? That kind of narrow range isn't even a narrow range, right? It's a big range. But that kind of IX10 is worthless because we're just stuck inside of a really big bar. What we want to focus on is periods in time where we're within a narrow range. Now, I've got February 9th here, and it's not the narrowest one out there. It's around 50 or 75 points. Looks like 75, maybe 80 points. So it's still a pretty good size range. But compared to Thursday and Friday of last week, well, it's a lot narrower than that. Now that we've developed this range, we're looking for the escape of this range. Some people are very particular about these wicks, and they'll call the setup broken even if we wick out of the ranges. Me, I'm a little less particular than that. As long as we didn't close outside of the range, then I consider the setup still in play. And as you can see, we haven't closed outside of the range yet. Ignore the moving averages. We're just tangled up with those. They offer no benefit, no support, no resistance, no nothing. So they are there, but simply because I didn't want to turn them off. So we want to focus on this range. It's around 75 points, and we need to GTFO, right? We get out of this before we can get anything else done. And you can see how it looks on the intraday. There's just nothing here, right? Big, violent, sweeping moves like we had yesterday doesn't offer anything. It's not helpful. I've seen a lot of people getting bearish on that drop yesterday, and I had to just quickly remind, hey, we didn't go anywhere. Sure, we dropped from 70.11 cog line down to 69.32 cog line. Isn't that cool? From one cog line to the next. But really, we didn't go anywhere. We were still within the ADRs. We were still within the floor pivots S and R level. We were still inside the narrow range. We didn't go anywhere. We just got there really fast. And that's what tends to freak people out, this rate of change, how fast we made that move. So we still need to get out of the box. And that's what we want to focus on. The weekly expected move did not signal that this week was going to be a narrow range week. We would have called that a hurry up and wait on Thursday or on Friday, and we would have prepared differently. So the volatility is pushed in here. And yesterday is just an example of that volatility. It's very likely that it's going to get worse before it gets better. So if you like this sort of trading style, this choppy, violent, sideways, nasty price action, then cheers for you, because we're probably going to continue to get that kind of price action. If you don't like it, then just hang tight, sit out, maybe study something, or go get some sun and just wait for all of this to change. Got to get out of this box. We had 53,000 in the overnight. That's right at our average volume level for the overnight. It's not indication that they sat out or that they came in really heavy. We're just right about what we would normally see, right in those mid 50s. It's fine. So they are participating, and that's kind of the long and the short of that. If there was something really big on the table today, they would have sat out in anticipation of that big thing, whatever it is. But we had economic data yesterday when we talked about the opportunity for this really big bar, that 8:30 event bar. They had come in trading yesterday in front of that, and they hadn't added any additional hedges. They weren't concerned about the data in any way. And that discussion we had yesterday about this event bar turned out really well. Generally speaking, I run 111 and 1236 on my fibs, but when you've got elevated trading activity, say like an event bar, you want to use halves and wholes. So instead of a 1236, we'd use a 1.5. And that reversal yesterday was right off of that 1.5. So all I did there is measured that 5-minute bar, that event bar that we had talked about in the pre-market. Measure that. That was the range that we had set. This is the close that we had to get back to close that liquidity gap. And the market ran up and tagged that measured move. That's why we use that, right? So I had people asking, what are we supposed to do with that? Well, you can trade it. You can use it for analysis. At the bare minimum, my goal was hopefully people wouldn't try to buy the open thinking that this big blue bar at 8:30 was some signal that yesterday was going to be a bullish morning and that they should buy calls or try to go long at the open. So if I saved someone from doing that, then it was worth the effort. Otherwise, destination trading. If we're looking to close the gap, then we're looking for price to get back to where that candle started. And then you, as a trader, would figure out where you want to get in as price is working its way back to that point. That's how you would do it. If you didn't want to trade it at all, then just use that candle for analysis. So those event bars can be really helpful. Here's our ADR lines for today. We haven't hit either one, just sitting here not doing anything. It's very likely that we don't get anything done today either. We can just sit here and do nothing. The argument against sitting here doing nothing is, well, that's what we've been doing. As I highlighted on the daily, that we're just wound up and doing nothing. Now we've got this sort of flat top rising wedge here. And those generally break down. So we'll see how it all turns out. It's a very small measure compared to all of this, these 3 days of sideways. We need to get out of this box. It's the long and the short of it. So you can focus on yesterday's mid. Getting below that kind of puts us on a target to the downside, which is 69.32 cog line. Get a break out of that to get to the ADR half. And if we get under that ADR half, then we'll target the full ADR. Remember, we're running 50s. So if we get underneath 69.50, then 68.50 is on the table. Our average daily range is now 94 points. I don't think it was very long ago when our average daily range was 63 points. Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it. That's also bearish. We've already cut through the floor pivot, so it doesn't have any value for that purpose. And at this point, we just want to focus on the S&R lines. The range of the pivot channel, the width of that channel, isn't as narrow as it could be, but it's a little narrower than yesterday. A wide channel implies that if we break out, that the breakout doesn't stick. The thing is, that channel's not going to make us break out. It won't stop us from breaking out. And if we do break out, it won't force us back inside again. It's just insight on what to expect out of price today. So if we do get a breakout, that range suggests that the breakout doesn't hold and we just come right back in again. R1 is still inside of yesterday's range, so if we make a run to the upside, just getting to yesterday's high will be a challenge because that R1 is in the way. Still, we get through R1, we get through yesterday's high, then we've got R2 way up here around 70.50. To the downside, if we get underneath this floor pivot, challenge our own Globex low, yesterday's low, and then S1 down here, which is really close to the weekly channel, the top of that weekly channel. So at this point, we really don't have much of anything to anticipate that we're going to get out of this range today. They're not hedging. They're not preparing for a big move. The economic schedule doesn't have something big enough to warrant an explosive move. Now, there could be headlines or some kind of gotcha that comes out that we didn't see coming. But at this point, we just don't have any reason to anticipate that today's going to be an explosive big move day. The range for the week is settling in nicely. It's a classic distribution, bell curve. There's absolutely nothing wrong with this. If I was looking to develop a slideshow of what a standard deviation looks like, that's about as good as you could get it. I don't think I could make one as good as that. So classic bell curve, very clean distribution, point of control greater than the mid. And it reinforces that A, we haven't done anything this week. B, we're developing our own coffin, so to speak. And the longer we stay in this range, the more that we reinforce this structure. So we're just building this out, right? That value area there. If we try to make a break to the upside, then we've got this 7,005. It's really just an overshoot of the 7,000 level. It's a high volume zone up there. And to the downside, kind of zoom out a little bit, we got this point of control from last week, 69.32 cog line. This is cumulative volume. Just think of it as net buyers and net sellers. If it's going up, it's net buyers. If it's going down, it's net sellers. We looked at this the other day when we were moving towards the lower edge of this Bollinger Band. Now we're off of that low. We've tested the mid and we're still struggling there. So buyers are still present. They're still coming into the market, but we're underneath that half. We got to get back through that so we can resume this move that we've been working on. This is called a cumulative volume index. Thinkorswim has one of these naturally. This is mine. Of course, I made some adjustments to it, but the CVI would function the same way. Mine just has lipstick. If you're on TradingView, instead of picking one individual market, like this one is focused on the NASDAQ, on TradingView, you can have it look at all of the markets. So it has an option when you go in there to do all, which is a heck of a lot better than this one where you have to individually pick which one you want. Still, it's good enough. It gets the job done. If we were seeing a wave of selling, just nonstop under the surface selling pressure, then we would see it here. And we don't. So a little weakness, but it's not like we're crashing and burning or anything. We need to look at the White House schedule. We didn't do that. All right. The White House schedule for today is low or moderate. There's not a lot to it today. Intelligence briefing, 2 policy meetings in the Oval Office. Looks like there's going to be some interaction with the press around 1:30 when he's making an announcement with the administrator of the EPA. So if you're looking for any sort of extra headlines or volatility that could come in, that 1:30 interaction with the press, that could certainly get it done. Because that's all he needs, right? It's just some access to the press. Somebody throws a gotcha question at him, and away we go. All right, so 10-day, 30-minute volume profile in TPO. The TPO looks fine. There's absolutely nothing wrong with that. The volume profile just really isn't helping out. We are above the point of control. I'll take that if that's all we've got. And we've got a relatively narrow value area. But outside of that, there's just not a lot here. We still need to take out this lower section, and we've got at least a week before we even get to these candles and begin the process of eliminating them. So we've got a long ways to go. I'd like to keep above this mid and this point of control and not get back outside the lower edge of this value area. Certainly don't want to reprint all of this. So if we do break down below the 69.11 cog line and get outside of this value area low, then that's the target, right? Is to retrace back down into 6,800 and then 6,750 and retest this liquidity down here. There wasn't much of a footprint left behind when we look at the profile that's here, but we'll test whatever's down there. That would not help us out at this point. We really want to stay above that point of control. No new VPOC from yesterday. You can see we've run through that level since last night, so no reason to carry it forward, other than the textbooks will tell you to carry it forward every day. I have no interest in doing that. I've got enough pivots. I don't need more. This morning, since we've spent hours up here at the top, that's where all of the volume is at for the TPO and the volume. So they're both just right up there at 68.90, 69.82, which is an old school cog line that we don't use anymore. Still, it's always on my radar, all those old cogs. So we're putting in a lot of work at that level. It's developing into a classic P-shape profile this morning, but it is today's profile as opposed to looking back at yesterday's. So, it does have limited value from that regard. Keep your eye on the width of the value area today. Watch for it to tighten up. Right now it's 15 points wide. See if we can get that compressed less than 10. That would be like winding it up for a move, right? Or plugging in your cell phone to charge it up, get energy to it. So tighten this range, really juice up the market, get us prepared for a move. $70.54 is this week's range top. $68.36 is this week's range bottom. So far, the best we've been able to say is that we're holding above Friday's close and we're in the upper part of this week's range. But we haven't done anything. We haven't gone anywhere because we're IX10. We got nothing. We got to get out of this box. First blush, if we can break through that 7,000 and begin the move to the upside, 70.54 is the target. Bare minimum, right? Just because that's the weekly expected move. It's what we're expected to do. We're still above the 10-week. Everything is fine there. There's nothing wrong here at all. So the market is good. It's a little violent for sure. The volatility is coming in, but there's nothing here that makes us think that we're in any way unhealthy, right? Being above the 10-week at all is good, and more than 0.5% is even better. I'd like it more if we were more than 1% away from that 10-week, but 0.5% is the benchmark I like to use, and we're greater than that, so it's a good start. If we drop below that 0.5%, it's likely that we gravitate back into the 10-week, right? It kind of just draws us in. So we want to maintain our distance from that 10 just to stay out of its orbit. Now for the 10-day, we're below the half, but we're within this collar that I focus on, 0.5% above and 0.5% below. In this area, trades are a little more calm. The pace of the tape is lighter. The positioning that comes in, the pace of that positioning, it's all just a little more subtle in this zone. It's like the calm in the center of a storm. So we're in that calm. We're looking to come out of that. Look for the expansion that pushes us greater than 0.5% away from the 10-day. We're not overbought or overextended in any way. We would need to get more than 1.5% away from that 10-day before we start thinking anything about having moved too far or too fast. So at this point, there's just nothing here. We can lean on that. Looking at what's going on out there, we got K-Web down more than 1.25, so that's the China group. Gold miners, or at least junior gold miners, down also 1.25. Just seems like a lot's missing out there. Another China one, China gold through GDX, and the Mag 7 down volume is down. And yes, that's a double negative. But if we look at what's up this morning, I got a lot of stuff moving to the upside today. Jets aren't quite there, but they're moving in the right direction. Same with bonds, mags, banks, generic tech, Bitcoin, uranium. All these are in the right direction, just not enough. So I want to keep our eye on those and see if they can keep pushing and get to the point where they're actually going to participate in our collaboration here. Otherwise, what we do have working with us chips way up here. Now, chips are up almost 9% in a 5-day period. It's getting a little too stretched. So, yes, they are up this morning. Be careful that they don't flip over on us and come knocking us in the head, right? You don't want to get too extended with those. It says that cloud is up. This one is a little tricky. It's one of those on Thinkorswim that could have moved in the after hours and not have made any move at all in the pre-market. And it would still show the move from the after hours, and that can be misleading. So when you see cloud up on Thinkorswim, just go and check. Make sure that it really is up from pre-market action and not from after hours. There's another one too. IGV does the same thing. So as we can see, nothing here from the pre-market. It's just after hours stuff. So I wouldn't count that one. The Mag 7 up volume is up. And like I said, we got a lot of stuff moving in the right direction. We just need more out of it. So we can see chips are doing good with SMH. But if we zoom in and look at this, we're still inside of yesterday's range. So it looks great. Like, oh, wow, yeah, we're up 1%. Yeah, but we're still inside of yesterday's range. We tried to get an inside day breakout, and that rejected. So we're still working on that. On the week, looks like we got an inside week breakout. So we are outside of last week's range. But we still got some work to do. Nat gas leading the market today is not exactly what you want to see if you're looking for an upside breakout, a big old rally day. You don't want a rally led by nat gas and pot stocks, which is what we've got here with MSOS. So chips, yeah, but that we don't want to see chips try to carry the whole market by itself. We want to see more. So we need this to broaden out into the other groups. %20 of the S&P is up this morning, 0.5%. It's not as bullish. It's not very bullish at all. Looking at the NASDAQ, 33% of the NASDAQ is up 0.5% or more, and that also isn't very bullish. So on the one hand, that's kind of a gift. You know, it sucks if you come in and in the overnight, everything's already run 2% or 3%, because then it's like by the time we get into the open, there's not much left for them to do. They've already made all the run. So I like when we're up a little and we're not up too much because it gives us room to run on the intraday. But on the other side of that is the idea that since it isn't getting set in stone yet and we're still in that squishy wishy-washy area, that it could just get unwound, and instead of getting this upside rally and a breakout and a move to up, that we end up flushing it out. So the good thing is, if that strength comes in, it will be very easy to spot. We're going to be looking for a rising tide that lifts all boats. So we want to see Mag 7 coming up. Consumer discretionary. Even some financials would be nice, although I'd rather see like KRE rather than XLF. These top three are the risk-on sectors. And you could add, you know, something more specific like cloud computing rather than tech, or chips rather than tech. All right, so tech is just really generic, but consumer discretionary and technology, financials. Those three are what's going to really facilitate a breakout rally day to the upside. If we're going to get that from breadth, then we're going to need more than just chips, right? So keep your eye on that. The other thing that could give us a breakout would be assistance from dollar, bond, treasuries, commodities. So gold, crude, the 10-year, cycle through those charts looking to see an outlier or a big move start. Because right now, if we're tightly wound, so is everything else. Even the VIX is very likely not doing anything and is just stuck in a range. Yeah, sitting tight, doing nothing. So if we're going to get that expansion to the upside, we should start to see the assistance come in. The VIX should, break 17 and start heading down, that sort of stuff, right? So on the one hand, it'll be a nice gift if we begin this breakout and run to the upside from our current situation, because that rising tide will be easy to spot. On the other hand, if we wash it and start dumping, then it again will be very easy to spot through dollar, bond, treasury yields, oil, whatever you want to look at. We should get that confirmation as the indexes begin to break down. We get the VIX crossing through, say, 18 and headed to the upside, and then a cycle through the rest of the charts to kind of get that confirmation. Take what we can get. So that's what I got for you guys today. Be careful, be safe, watch the clock. It got that 30-year, and I'll see y'all tomorrow.